All right, welcome to part three of basics of market structure. Previously, we've already talked about how to identify market structure, how to identify the trend that we're in. The video before this one, I introduced to you structure points, zones and areas of interest, and breaks of structure. This video, I'm going to go more in depth into the reasons as to why the market moves. I've already previously mentioned how the market moves through buying and selling, right? Now I'm going to explain why and where this buying and selling occurs, right? So there are zones in the market, like I told you before, these areas of interest, these structure points. These are zones of where there's increased volume, right? People are conducting more buying and selling from these areas. Because of that, that's where we're going to be conducting our buying and selling from as well. It's important that you understand that we're going to be the main thing is that we want to be where the volume is, right? Because without volume, there's no movement in the market. So why is there movement in the market or in these zones? Why is there volume and buying and selling being conducted in these zones? Is liquidity. There's liquidity and orders. These two kind of go hand in hand. Orders essentially are liquidity, but um, within these zones, right, there is liquidity, and what liquidity is like I just said, orders. So let's say if we have moved like this, um, price, there's a big impulse move, right? A fast impulse move from this area here. This swing low here, this structure point where price breaks a previous higher high, right? Because this move happened pretty fast and there's a lot of volume here that was pushing this movement to the upside, there's gonna be orders left over, right? Why are there orders left over? Because the move happened so fast that not everybody could get into the trade at that price, right? What happens is when the market moves so fast like that, market our orders get left over. So they're still sitting there waiting to get tagged in at this price to go up, right? So they're left behind, and what the market is going to do is going to come back down, right? It's going to seek out this liquidity. Because why? Liquidity is what moves the market. Liquidity has the volume. Liquidity provides the volume. So the market is going to seek this liquidity. Price comes down, gets into this zone, tags into the liquidity, and moves higher. All right. So within these zones, there's liquidity. That's what moves the market. And like I was saying just now, the market is naturally going to seek the liquidity. All right. So our job as a trader, in terms of with the strategy and when we're entering trades, we're trying to enter at zones of impulse, right? Like I told you before, we want to find areas of reaction. Why? Because there's liquidity in these reactionary zones, these areas of interest, these structure points. All right. So you will see as you look at charts more that price moves essentially from zone to zone. So when we're looking at the market, right, and you're analyzing where the market's gonna go next, where I'm going to show you how we're going to be targeting zone to zone essentially. So let's say if we have price looking like this, I'm just drawing random shit right now and I can do that because it still applies. So see how here we have zone here, right? Price entering this zone. There's leftover orders here because the move was so big. So we're gonna target sells here, go up into that zone, tag into liquidity. What are we gonna target next? The next zone. Why? Because the next zone has the liquidity. There's not much liquidity in between this area here and this area here. Why? Because there's no change in movement there. There's no liquidity there. Here, down here, or here though, there's liquidity. So that's what we're gonna be targeting. I'll go more in depth into that in the future when we talk about the strategy itself. But I just want to show you why the market moves, and that liquidity essentially sits within these zones. And like I said before, to understand what liquidity is, just know that liquidity is just orders. It's just a large amount of orders sitting in a certain place, right? So they're gonna be sitting in these zones, a little bit past these zones. I'll go more in depth into that, but just know that all liquidity is a large group of remaining orders that are waiting to get tagged in. All right. Like I might have overcomplicated that a bit, so if I did, text me, ask me again to re-clarify, or ask me why I said a certain thing. But just know, if everything I just said before didn't make any sense, just all I need you to know is that the market moves through liquidity, grabbing liquidity, and all liquidity is orders or people entering the market, right? So that's all it is. Just to give you an example here, I wanted to give you an example. So this is a picture perfect example of our setup. I'm not going to go into the nuances right now, but essentially you can see here, right? So we have structure here, right? Currently, and here we're kind of ranging. Going into it, we were bearish, high, low, lower high, lower low, lower high, equal low, lower high, and then here we start ranging. As you can see, we have um I guess you can call this a lower low, but I call this just like an equal low, and then equal high, low. Here though, off of this zone, this is a structure point, right? This is a, if I change it like to the line chart, it's the same thing as like I showed before. These are structure points here. Structure point, structure point, structure point. Within the structure point, there's a zone, right? So let me show you what the zone looks like. This is the zone. From this zone, price pumped up, and what did it do? Broke structure. You can see here, price went up and closed above these structure points here. Let me show you again on the line charts. See, from this structure point, price went up and broke above these previous structure points here. So what does that tell us? That there is volume in this zone, right? Volume in the market in this zone. There's what? Liquidity here, right? Because there's leftover orders. The movement happens so fast here that there are still orders left over here to be tagged. So what we're gonna do is we're gonna wait for the market to enter this zone. All right. Ooh, boom, price. See how price reacts from this zone? Because why? There's volume, there's leftover orders, there's liquidity sitting in these zones. Boom, price enters, big rejection here. I'm gonna go more in depth into wicks and bodies in the future, but just know that there's a big rejection. Why? Because price has entered the zone and there's a lot of liquidity and volume here. So here, what I'll be targeting here, this is a little sneak peek into the strategy. I'm gonna wait for the break of the previous candle high, and then target 1 to 1. I don't know if it actually wins here, but just to give an example, let's see what happens. Boom, it's an immediate win. Look at that, clean ash trade. So what you see here, you see break of structure to the upside, creating a zone, and then price coming back into that zone, taking the liquidity and going up. This is, you're seeing picture perfect here how the market moves and why it moves. All right. So if you have any questions about liquidity, I might have overcomplicated this concept. Just know liquidity is what provides uh, the volume in the market. This the areas of liquidity, same thing as the area of interest zone. This is where the buying and selling conducts, right? This is where the liquidity lies, these zones. So text me if you got any questions, and that's liquidity. Next video, we're gonna go into how to like look at candlesticks, basically the anatomy of them and what to look out to identify volume and stuff like that. So yeah, just let me know if you got any questions.